You check your bank app, expecting to see exactly what you left there last month. Instead, the number is lower. You check the transaction history and see a sudden deduction, simply because your balance dipped below an arbitrary threshold. For a wealthy account holder, a minimum balance requirement is invisible, but for a low-income worker, it acts as a direct tax on poverty. When cash is tight, the banking system actively reaches in and takes a fraction of their savings, precisely when they can least afford it. This creates a strange contradiction. Today, you can buy a single cup of chai at a corner tea stall using a smartphone. The digital infrastructure is highly advanced, yet the underlying banking structure still locks millions of people out, or quietly drains their accounts through fee structures that penalize low balances. The Reserve Bank of India recognized that you cannot have true financial inclusion if the cost of entry is too high for the average citizen. To fix this, the RBI issued 7 specific amendment directions, taking effect in April 2026. These regulations rewrite the Code of Basic Banking to remove the hidden penalty structures that have defined savings accounts for decades. The policy forces banks to absorb the cost of maintaining these accounts. The responsibility of keeping the system accessible is moving off the shoulders of the consumer and onto the ledger of the banking sector. The first major defense mechanism in these new regulations targets the surprise factor. Banks are now legally prohibited from executing deductions for low balances without first notifying the customer. The RBI mandates a strict alert system. If an account approaches a fee, the bank must send a warning before touching any money. This creates a mandatory grace period, giving the user time to deposit funds and bypass the penalty. A warning system is a strong defense, but it relies on the user having spare cash to deposit. For individuals living paycheck to paycheck, a warning isn't enough. They need a structural guarantee that their balance can safely hit zero. By forcing banks to communicate before they penalize, the system moves from extracting money after a mistake to preventing the mistake in the first place, putting financial control back in the hands of the account holder. For those who need a permanent shield from fees, the RBI is revamping the framework for the Basic Savings Bank Deposit Account, or BSBD. The defining feature of this account type is simple. It legally requires a zero minimum balance. You can leave the account completely empty for months, and the bank cannot charge you a single rupee in maintenance fees. Banks are also required to provide standard physical tools completely free of charge. That includes a debit card, a checkbook, and 4 free physical transactions per month. Crucially, this limit does not apply to digital volume. Account holders can make unlimited transactions using UPI, NEFT, or RTGS without triggering a fee. Anyone currently trapped in a high-fee savings account can request a conversion to this framework. By law, the bank must process that switch within exactly 7 working days. To ensure the system is not exploited by high-net-worth individuals opening dozens of free accounts, the regulation includes a strict cap. A customer is only permitted to hold one of these basic accounts across the entire Indian banking network. The BSBD isolates the essential tools of modern banking, storing cash, using a debit card, and sending digital payments, and strips away the requirement that you have to be wealthy just to use them. The RBI is mandating this regulatory baseline across the entire Indian banking sector, regardless of an institution's size or ownership. Every tier of the financial system is bound by these rules, including commercial giants, small finance banks, regional lenders, and cooperative banks. The goal is a uniform regulatory baseline. A farmer opening an account at a small cooperative in a remote village is now guaranteed the same treatment as an office worker banking with a multinational firm in Mumbai. For decades, securely storing cash in a formal institution came with a barrier to entry. Now, the baseline ability to deposit and protect your physical wealth is safe from silent attrition. By April 2026, the structural mechanisms that allowed banks to penalize low-income users will be dismantled. Going forward, the formal banking system will be forced to accommodate economic vulnerability rather than punishing people for it.